Hi, everyone, and thank you for joining us for today's webinar on capturing 45Q tax credits in today's regulatory landscape. My name is Alan Alexander, and I have the pleasure of introducing our two speakers. First up is Jenny Speck, who is a partner in our tax practice. She advises clients on the qualification for and monetization of energy transition tax incentives, including for projects intending to claim or that are currently claiming the 45Q credit. Jenny is a well-rounded advisor in this space, having advised clients on 45Q eligibility while with Deloitte's Washington National Tax, having been in a client's shoes during her time as the Senior Manager of Tax and Regulatory Compliance at Navigator CO2 Ventures, also as an independent merit reviewer of the Department of Energy Loan Programs Office for carbon capture and storage demonstration projects. And now, she's humbled herself a bit as just a partner at B&E. If I can brag on her, though, I would like to say I've worked with her quite a bit, and having someone who's been a project sponsor, been in government, been in an accounting firm, and an outside counsel perspective is unique. She really understands how these transactions come together from both a legal and commercial standpoint. Our other speaker is Hoo Ray. He's an associate in our finance practice, also someone I've worked with quite extensively over the years. He focuses on project development, project finance, tax equity transactions, and he really is a guru when it comes to tax credits involving molecules as opposed to, say, maybe electrons. And by that, we mean the credits like 45Q, 45V, and 45Z. I can say firsthand, we're seeing an uptick in deals in the 45Q space. We've seen a lot of CO2 offtake agreements, a lot of projects getting ready to move to proposed FID. These are deals that are incorporating sequestration, various types of equipment, et cetera. And without these tax credits, these deals can't happen. We just signed one this week where the 45Q economics were critical to getting the deal done and the project getting built. Jenny and Who, it goes without saying, are integral to these deals, and I'm excited to hear them and what they are, currently seeing out in the market. However, before I kick it over to them, a few housekeeping items. First, you should see the speakers as well as the presentation on your screen. However, if you're on a mobile device, your view may be modified. We will leave some time to answer questions at the end of the program. To submit a question, please use the chat function at the bottom of your screen. And finally, this is a CLE accredited course. If you're seeking credit, keep an eye out for and answer the 3 polling questions that pop up during the presentation. That's how we know you actually attended the course. You'll be alerted via chat when a polling question is live. So with all that aside, let's get started. Jenny and Who?
Thank you, Alan. Appreciate it. So going to the next slide, one more over. Perfect. All right, today's agenda, as Alan alluded to, we are going to talk about the Section 45Q carbon oxide sequestration tax credit. We're going to cover the changes under the One Big Beautiful Bill. We're going to talk about the EPA's proposed changes to Subpart RR and the safe harbor that was published by the IRS at the end of last year, how both of those might influence how you're planning on claiming these tax credits for the 2025 tax year. Last but not least, we're going to cover a couple of other things that are really exciting. We're working with a lot of clients on, and that's credit stacking, the ability to stack multiple credits at a certain site potentially. And then monetization, everyone's favorite topic. How do we actually turn this into real economics? Okay, so let's head into changes to 45Q. Real quick, I'm going to cover a lot of background on 45Q that you're not going to see here on a slide. We have slides here that are a little more concise at the outset, but we have an annex attached that includes a lot of the overview that I'm going to cover in case you are like me and you want to learn more about 45Q. But 45Q, I like to call it, America's sweetheart tax credit. It's been around since 2008. It has had multiple facelifts, improvements, modifications under both Republican and Democrat parties. This tax credit has only gotten better with time. Let's talk about what it is. It incentivizes the capture of carbon oxides and the use of one of 3 end uses. One can be utilization for a commercial product or a commercial service. The other can be for a tertiary injectant, such as enhanced oil recovery, natural gas recovery projects, and last but not least, sequestration, so secure geological storage. Under the One Big Beautiful Bill, we have parity for all end uses. That means I can now get the same $85 per metric ton regardless of my end use. The only anomaly is direct air capture still has a much higher credit value, but that's obviously because it's a very expensive technology. Other items that the One Big Beautiful Bill did is it introduced new FEOC compliance. FEOC, in this tax credit world, we're all well aware that we like to use acronyms. FEOC is one as well. It's going to be foreign entity of concern. Before we get into what those rules mean, I quickly want to highlight that everything else is largely the same for 45Q. We have a begun construction deadline, which most tax credits have. You have to start construction, which is a term of art, before January 1st, 2033. The monetization structure is the same. Direct pay, transferability are still on the table. We'll go into more details on what that means. And our lovely prevailing wage and apprenticeship compliance, all thanks to the Inflation Reduction Act, are still very much alive, well, and causing a little bit of headache here and there. And we'll get into what we're seeing in the industry on that as well. So let's go ahead and jump into FEOC. Okay, so under the One Big Beautiful Bill, this new compliance, requirement, however you want to label it, it was literally integrated into every tax credit but one. Hydrogen snuck away from FEOC compliance. The prohibited foreign entity is basically the threshold that we have to evaluate and say whether or not the taxpayer is a prohibited foreign entity, okay? The prohibited foreign entity rules largely look at who are these bad actors that the government does not want to benefit from the tax credits. So as you can imagine, there's no surprise here. It's, North Korea, Iran, Russia, Chinese, right? So are you one of these entities? And if so, it could be a problem for claiming the tax credit. We can talk about strategies at the end of this, but generally there's a blanket prohibition amongst a lot of the tax credits on you cannot be one of these prohibited foreign entities. You cannot transfer the credits to one of these prohibited foreign entities. But the FEOC rules do not stop there. They look at not only your equity, they look at your debt, and among a few other factors. I like to analogize it to an onion. The more you peel back these layers, the more you might cry, and the more you might be a little confused on how do I even comply with this? You also cannot be a foreign controlled entity. You cannot be a foreign influenced entity. They thought of every types that you just cannot be. And it looks at different levels of ownership. And we have these percentages put on the page here for you to review. And like I said, you can circle back at a later time. But our concern here is it's really become a huge compliance burden on how do we solve for this new foreign entity restriction, right? So what are you hearing? What are some of the top questions that we are getting day in, day out on FEOC, and specifically as it relates to 45Q?
Yeah, I mean it's generally the large question people have is like, how do I do this? I know we're throwing out a lot of defined terms. We've clicked through a few different slides. People talk about FEOC compliance, and we talk about FEOC compliance in general terms frequently.
Mm-hmm.
But we have these sort of prohibited foreign entities is the technical prohibition, but that's an umbrella term that covers
Mm-hmm.
both foreign specified entities, foreign controlled entities, and foreign influenced entities. And it's that last section, that foreign influenced entities, that we see the most hair trigger issues and the diciest problems for 45Q taxpayers. 45Q, fortunately, was spared some of the more difficult FEOC related requirements that we see in some of the other tax credits. We don't have what are called material assistance requirements, and we don't have
Right.
effective control requirements. If you look at some of the reporting on these tax credits, you'll see those issues come up frequently. Fortunately, they're not going to be relevant here. But what is relevant is establishing and looking up your ownership chain, showing that 60% of my ownership is not a foreign specified foreign entity. For some taxpayers, it's really straightforward. For other taxpayers, especially in the private equity space, anybody who has funds in their ownership structure, this can be really difficult just because of the opacity of those structures. We're also seeing a lot of people struggle with debt. Sometimes it's really straightforward. If you're a relatively young company, you don't haven't issued that much debt, it can be straightforward. But if you're an older company, with the absence of
Mhm.
guidance, we're looking at the whole universe of your company's debt to see whether or not you have a foreign influence entity. That can also be really tricky. Um, so those are the pitfalls and the main challenges that we're seeing people struggle with, and it's a really live issue. Everybody in this space and the other renewable credit spaces are struggling with this right now and coming up with some solutions. And and those solutions can range from, and this is I'm working on several of these right now. Is just diligence, getting your owners, getting your debt providers
Mhm.
certifications as to their foreign entity status and their ownership status. Those things can be put together, counted up, and if we can get to the relevant threshold, showing that we've established that more than 60% of our ownership is not a specified foreign entity, then we can be comfortable that we are not a foreign influence entity and we don't have an issue here. Uh, where it gets tricky is when you have a problem, right? We have seen spin outs of companies where people have spun out some of their companies to get out of their specified foreign entity control. Jenny has been working on, I know at least one that she's been working on to get compliance for these rules. So it really runs a gambit from, is this just a diligence burden, just something that we have to figure out? Or is it something that we need to really restructure and get around? And Jenny and I were talking before this call, and one of the special things about 45Q is that it goes, unlike a lot of the other tax credits, you can really control who ends up getting your 45Q credit by working with the ownership of different pieces of carbon capture equipment and working with who is actually ensuring the disposal of CO2 that's been captured at a facility. And you can do that to push the relevant taxpayer around to hopefully get a cleaner entity that's easier to establish that it's compliant with these fiat requirements compared to perhaps the person who was previously claiming that 45Q credit.
That's
This is
right.
also
Yeah, I was just going to echo real quick, as you mentioned, we are going to talk about some other credits later on, the clean hydrogen production credit, the clean fuel production credit. Just know 45Q is an anomaly compared to a lot of the other credits. You don't have to be the owner of the qualified facility. You only need to own a component of the carbon capture equipment. So if you're looking around the room right now and realizing, hey, we might be a prohibited foreign entity or a foreign influenced entity, now is the time to strategize on how do you structure it so that you have someone with clean ownership owning the component and ensuring the utilization, sequestration, or disposal, right? Another item to think through in terms of fiat compliance is how do we contractually try to give you protections too, right? There's reps, warranties, covenants that we can provide. This is something we're seeing, certificates, other types of means, like as who said, the diligence has kind of turned into a nightmare a little bit here. What can we do to help decrease that burden? And again, it just takes open collaboration with your counsel and also the other party because they equally want to make sure they're not a fiat. So this is something that everyone needs to be aware of. It's going to be something that's around for at least the near term. So I think we just need to start recognizing this is going to be a diligence headache and thinking through how we can efficiently tackle it. It looks like we just launched our first poll, FYI, in case you're wanting to get CLE credit. We'll give a minute before we move on. Who do you want to go ahead and set up our next topic while we give everyone a second?
yeah. So this is one of the requirements that was introduced for the Inflation Reduction Act, and these are these prevailing wage and apprenticeship requirements. Um, Several years back, this was a really hard thing to make happen. We now have a lot of third-party providers and consultants who are out there providing services to both diligence your prevailing wage and apprenticeship compliance, as well as establish compliance regimes to sort of roll this in seamlessly as much as it can be into your operations. We this finds its way into EPC agreements, into your subcontracting agreements. It pops up in basically all of your project level documents. You're going to end up seeing some provisions related to PWA. But the main thing that we really want to highlight is for people who are considering new things like natural gas processing facilities, new facilities that may be emitters of CO2 that down the line may end up adding carbon capture and sequestration equipment. So for qualified facilities, that's the thing that's actually producing the CO2. If it begins construction after January 29, 2023, it needs to comply with PWA requirements. That's really surprising for a lot of people. Some questions whether or not it's even a prudent way for this rule to work. But this is the way the sort of plain language of this rule operates. And so if you end up sort of having a new gas processing facility, or you've just constructed your ethanol facility and you are looking a couple years down the line at CCUS, the time to make sure you have the data necessary to ensure PWA compliance and cure any of the issues that you may have had is really now. Almost all of the prevailing wage requirements can be cured using cure payments and their penalty payments, and some of them can be a little aggressive, but they're curable, and it usually makes sense, almost always makes sense, to cure those things and get the full 5 times multiplier on your credit value. But you need the data to do that cure and make sure it withstands both, your lenders, your credit purchasers, your auditors, and your IRS auditors, their scrutiny. We really wanted to emphasize that this is something that should be on your radar, even if you don't currently have CCUS in mind. At least make sure your contractors, your laborers, and mechanics are giving you the relevant data that you need. And that's contact information, that's hours worked, that's what they did, that's certified payroll. All of those items can be really tricky to get a hold of after the fact, especially a couple years down the line, especially when you're working with less sophisticated contractors who may not be used to providing that level of detail and needing to get them up to speed to be able to provide that data.
That's right. And so some strategies that we have seen implemented and just, again, taking a step back, these prevailing wage and apprenticeship rules were introduced under the Inflation Reduction Act. They've been around for several years. A lot of people have heard of them. Remember, I want to point out, as this last bullet point says, a violation is generally curable. As Who is alluding to, though, if you don't have great record keeping, how do you cure? And will the IRS be sympathetic that, oh, you did not collect records? Sorry, yeah, sure, we'll give you your full tax credit. I've not met an IRS agent who is that generous, but hey, maybe they're out there. So absent having generosity from the government, it is best to have great record keeping practices. Excuse me. And one other thing to keep in mind is, well, what if I can't cure, right? What do we do in that scenario? We've been looking at the scenarios of both qualified facility being built after January 29, 2023 and carbon capture equipment, right? How do you draw a box and ensure compliance from a prevailing wage standpoint? One idea is if you did not have a qualified facility that was built and complied with the prevailing wage and apprenticeship compliance rules, maybe you consider doing what we call an 80-20, retrofitting this facility so that you have a new original placed in service date that during that 80-20 construction, you would comply with PWA, and once placed in service, you would be able to demonstrate such compliance. And maybe it's at the same time as installing your carbon capture equipment anyway, so you're going and record keeping both compliance with activities that would substantiate any lender, any future tax credit buyer, and especially the government, right? The 80-20 test, just to give you some more ideas on what that means. The 80-20 test looks at the fair market value of your existing components that make up that qualified facility, or if you were to do it at a carbon capture level, the carbon capture, and whether or not after you retrofit it, does 80% or more, based again on the fair market valuation, consist of new components, and the used needs to make up 20% or less. Hence our 80-20 rule. It has been around for decades. We've used it in the wind industry. We've used it to repower solar farms, you name it. It is very much alive and well and actually referenced in the 45Q regulations, because remember, you have to have an original placed in service date under the statute. And I have seen some taxpayers consider, well, can I go buy a used system elsewhere, bring it over here, install it, and get a new 12-year period? You would be similarly facing an 80-20 rule in that scenario as well. So just keep in mind, if you're incorporating used components or you're wanting to restart the clock on your PWA compliance, 80/20 is a good option and one that we work with often. In terms of other things to consider for PWA, we'll talk about it later in monetization, but your compliance really does matter to your lenders, to tax credit buyers. No one just accepts a rep anymore that you're going to comply in a covenant that you will continue to comply, right? They want to see third-party compliance reports. They want to understand, did you owe any penalties? Did you owe any underpaid wages? And just so you know, for the 2025 tax return due, the IRS has a new form called basically the PWA correction and penalty form. It's going to be a real report of, did you have to comply with PWA? If yes, did you have any underpayments or penalties owed? So there's going to be a record keeping of any PWA non-compliance filed with your tax return as well.
And I just want to emphasize all of this stuff has interesting contours to it. We think it's interesting. Our clients usually find them frustrating. That's how this goes. But all of these things, we really need to understand your facility. We talk with your engineers, we talk with your site managers to figure out how your facility works. Because so embedded in some of this stuff, we're saying qualified facility, figuring out what actually constitutes your qualified facility is an inquiry in itself, and figuring out what scope that is and the scope of the equipment that needs to actually comply with PWA is its own sort of analysis. And it really is dependent upon how your site is set up, what it's actually doing, and how it operates. That goes into also in the 80/20, which costs are we able to look at to build up that new property, which costs are we able to look at to figure out what the used property is in this situation. Generally, we stop at the point of transportation, right? So once you've sort of captured this CO2 and you put it into a pipeline, that's usually where we stop. But again, we always want to look and make sure that nothing, there are no exceptions in place, nothing odd is going on.
One thing I want to hit real quick, Hoo, and make sure it's abundantly clear, the scope of PWA. Does it apply solely to the carbon capture equipment, the qualified facility, or is there a world where it applies to the pipeline, the sequestration well, right? Based on the rules, it very much focuses on two things. The qualified facility, as Hoo said, is the industrial emission source, and the carbon capture equipment. Carbon capture equipment includes all equipment necessary to capture, process up to the point of transportation. Now, we mentioned 80/20. There is an anomaly that the government recognized an ability to include some pipeline expenses in turn of making sure you hit your 80/20 cost. I would be cautious in that scenario. I don't know how you would contract to try to differentiate and put maybe Apple AirTags around their neck on when they're moving around on site. Did they go to the pipeline, or if it's a gathering line? There's a world in where we can defend, carbon capture equipment qualified facility must comply. But there's also this practical side on when you're contracting, does it make sense to try to limit exactly where they're at to comply with PWA? The answer probably is no. I've not seen many contracts bifurcate out to that level. But just so you understand, the rule is it's carbon capture equipment and qualified facility are subject to PWA, but you might just want to be thoughtful in how you're actually signing up your EPCs and subcontractors to just ensure, big picture, you're in compliance and not get into the weeds too much unless it's extremely costly. And I don't want you to take it away as like Jenny said, we have to make sure PWA is on the pipeline. It's generally always no. I just wanted to throw out that 80/20 anomaly in case that fell into your fact pattern that you should consider how you're contracting. But generally, it's only going to be the carbon capture equipment and qualified facilities subject to PWA. Okay. Now that we've covered more than you wanted to know on PWA, let's go into our next subject, Hoo.
Yeah, so this is we're going to hit on some of the proposed changes to Subpart RR and this recent reporting safe harbor that we got from Treasury. Sort of in one of the earlier sort of rushes of executive orders out of this Trump administration, I believe it was unleashing American energy. Most of the government was directed to try and pull back regulations that weren't seen as necessary anymore. And the EPA responded to that. And as part of their response, they proposed rules to eliminate reporting under Subpart RR. You'll also hear this referred to as the Greenhouse Gas Reporting Program, Subpart RR. This is it's a greenhouse gas reporting program where certain folks are required to report their CO2 emissions as well as several other items, provide a lot of data to the government. Folks doing, oh, let me get this right. Folks doing non-EOR were obligated to report under subpart RR. Folks doing EOR were required to report under different subparts of the greenhouse gas reporting program. But when Treasury was coming up and the IRS were coming up with rules for 45Q about how to establish how much CO2 has actually gone down the hole, how much has leaked out of that hole, they turned to subpart RR and piggybacked off of that for non-EOR. They also, for EOR, pointed to ISO 27, I'm just going to refer to this as the ISO standard, pointed to an ISO standard for EOR sequestration. So 45Q really relies on subpart RR. It pops up in a lot of places. It's in your reporting requirements. It's also goes to your recapture period. It pops up in a bunch of different places. And when EPA came out and proposed to eliminate this program, a lot of folks were really worried because they didn't see a compliance path moving forward. Reporting under subpart RR is all done through this eGRIT system. It's an online portal that EPA maintains, and it has not yet been open for 2025. EPA actually extended the due date for all greenhouse gas reporting out until I believe October 30th of this year, rather than it's typically much earlier in the year that folks have to do their submissions. So folks were understandably worried, right? They didn't see how they were actually supposed to comply with their reporting obligations. Fortunately, the EPA decided to provide a safe harbor that had some limited relief. So IRS Notice 2026-1, you want to go take a look, provides a safe harbor just for 2025. So we don't know what's going to happen for the carbon that's sequestered in 2026 if eGRIT is not open by June 10th, 2026. So we should get some certainty about whether or not you're going to be able to rely on the safe harbor very soon. And this is basically what it requires is for taxpayers, instead of submitting your reports, all of your subpart RR reporting data to the government through that module, you instead need to engage an independent engineer or a independent geologist to verify all that information and then certify the information and submit all of that material to the IRS as part of your returns. You have to do that by the due date for your returns, including extensions. And this is a big change. A lot of folks were used to doing self-certifications under the subpart RR program and weren't used to bearing the cost of engaging with an independent engineer or an independent geologist to verify their information. That's one of the main differences between the subpart RR approach and the ISO standard. People saw it as a nice, even though subpart RR can be a little bit more technically burdensome, it was a cheaper approach for most folks, especially because there was overlapping reporting for a lot of people. And so even EOR users who are used to, who have the ability to use the ISO standard, a lot of them frequently use subpart RR and are now, because they were not addressed in this safe harbor, going to need to take that ISO standard approach. So if you are a person who does sequestration and you use it for enhanced oil recovery, you really should start working with an independent engineer. Maybe you've got a couple of weeks to decide whether or not to do that. But you should really consider engaging an independent engineer or an independent geologist to start working down that ISO path, because a lot of your technical information is going to be set up for that subpart RR approach. And you want to make sure you have time to translate that over and get that certified by your independent engineer and maintain compliance. Jenny, I mean, have you seen, what have you been seeing as far as folks are navigating the uncertainty around the proposal to get rid of this reporting obligation, as well as the subpart? I'm just going to flag for folks that we do have another quiz. I think you might have missed it.
It was up for a good minute. I imagine they saw it. If not, please just let us know in the chat box if you need help with your CLE. What are we seeing? I think it's important to think about where we're at with this administration. This greenhouse gas reporting program is not an anomaly. This is not the first of any programs that the administration has encouraged, maybe a scale back of certain reporting obligations. Might not be the last. I do think that taxpayers are a little frustrated that maybe left hand and right hand of the government aren't really speaking. The IRS was, I think, kind of caught on their heels in terms of not understanding that the EPA was probably going to have to roll back or potentially modify the greenhouse gas reporting program. I think there was obviously some great lobbyists who snuck in and got, I don't even know what they say, they snuck in. They walked right in and said, hey, we have a real problem here. Greenhouse gas reporting programs not limited to just 45Q. It actually shows up in our clean hydrogen production tax credit. So I think a lot of people were worried, how do we ensure compliance? How do we make sure that we're planning and can timely take these tax credits? We're sitting around waiting for the EPA. I have seen some start to engage independent engineer and geologists, start getting familiar with the new ISOs. I think it's something that I would not be surprised if we do not have the egret come out by June 10th. I really am I'm usually optimistic at this point. I think, who we saw a new ISO standard released recently that had relationships with geological storage. I would not be surprised if we see that come out and be required. One thing I also want to note in terms of big picture, the priority plan of the IRS was published last fall. 45Q guidance was listed higher than some of the other tax credits that are still without guidance. You have to remember, the 45Q guidance has not been updated since 2021, January of 2021. A lot has happened. The Inflation Reduction Act happened. The One Big Beautiful Bill happened. There has been a lot of changes from a statutory standpoint that are still not reflected in the regulations. So I would not be surprised if we see something in the near term that is maybe proposed regs that are temporarily replacing some of the prior final regs and introducing new reporting obligations. I don't want you to take that as, oh my gosh, they're going to just throw away everything that they did previously. Remember, I think it's going to be a limited scope on what they change in the regulations. So if you're concerned about what is to come, I would think about what has changed statutorily, right? We know the qualified facility definition has changed. The begun construction deadline was pushed back. The capture thresholds were changed. We have a lot of various changes that should not impact your recapture period, things that might be causing you some concern right now. So just recall that some of it will be safe, some of it will be retained, but I do think there's a world where we see soon new reporting obligations to help alleviate not knowing what the EPA is going to do. Okay, I think we've covered the safe harbor sufficiently. Let's get into something else that's been taking up a lot of our time.
Yeah, yeah. Hey, so this is credit stacking. It's sort of a bad word for a lot of folks to say credit stacking, but really what we're talking about here is the interplay between 45Q, 45Z, and 45V. You'll sometimes see interplay with other credits, but they're technically possible, but we haven't really seen them pop up very much. 45Z is a clean fuels credit. This is a credit that is available to certain clean fuel producers if their fuel falls below some emissions threshold, and the credit increases the lower the emission rate. And there's not going to get too far into this, but think about your ethanol producers, your biodiesel producers, your SAF producers. All of those folks are all under this 45Z regime, as opposed to the variety of different credits that existed before. And some of you might be familiar with the blenders credits that existed. All those have been condensed into this 45Z credit. Then you have 45V. 45V is the hydrogen credit. This was introduced under the IRA. It was proposed to be eliminated in some of the earlier drafts of the One Big Beautiful Bill. And then somebody in the Senate pushed out the deadline for the safe harbor construction date, the beginning of construction date for 45V. And so it survived basically unscathed from the One Big Beautiful Bill. It does not have any of the fiat requirements attached to it, and it has caused some increased interest in that credit after it sort of fell out of favor for a minute there. Each of these credits, 45V and 45Z, depend on the emissions rate of their product to determine eligibility for and the amount of credit that's available. 40, carbon capture is a great way to reduce your emissions rate and to increase your credit. The approach taken both for 45Z, it's currently just got proposed regulations, but for 45V, we've got final regulations. The approach taken in both of those, as a general rule, if you've got carbon capture equipment that reduced your emissions rate, you don't get to claim 45Q as well. To be more precise, if you claim 45Q on that carbon capture, you can't claim the 45Z or 45V credit for that facility. However, if you did not include that carbon capture equipment, the reduction in your emissions attributable to the sequestration of CO2 in your emissions rate for these other credits, you're able to take those credits in parallel. There are certain situations where we're concerned that sort of your carbon capture equipment is too deeply entwined in your production facility to really be able to pull it out. But for a lot of producers, your carbon capture equipment is just kind of an appendix that you've stuck on to the end of your facility. And in those cases, we're much more comfortable that you'll be able to claim both credits in parallel. But would you want to? When we look at the value of the 45Q credit on a metric ton basis versus the value of this 45Z and 45V credit, when you reduce your emissions rate, we almost always see a higher credit in these other credits per ton of CO2, if you consider its impact on your emissions rate, than if you were to claim the 45Q credit directly. If you're in control of both halves of your facility and can freely decide whether or not you're going to take this credit or that credit, you can really play with it and optimize things. Where we've seen challenges as well as some really interesting contracting is where you have somebody where one party has a carbon capture setup at a fuel production facility, and they have been taking 45Q, and suddenly this 45Z credit becomes available. And everybody knows that the aggregate credit would be higher if we were to take the 45Z credit. But we now need to figure out some way to allocate the economics of that 45Z credit. And it's difficult to do that within the credit regimes themselves. And so we've seen some really interesting sort of revenue sharing approaches. I also note that it is worth doing this math. So 45Z with the One Big Beautiful Bill, we was given a floor in the amount of credit that you can get. And it's theoretically possible for you to produce so much and capture so much CO2 that you actually dip below that zero level. And you may end up having to readjust your optimization and figure out that actually I'm sort of wasting some of my captured CO2 given that floor. It's heightened because of some of the changes in the way 45Z is calculated after the One Big Beautiful Bill as well. So those are some of the big things. Jenny, I don't know if you want to hit on some of the exciting times.
Yeah. So I think it's important to kind of go through, how do you decide, how are we evaluating when you might be able to stack, right? And so it is a tax definitional analysis. All right. 45Q, we're naming the alphabet soup here. So just bear with me. 45Q evaluates your single process train of carbon capture equipment, as I mentioned earlier. That's all the components necessary to capture, process up to the point of transportation. Now we have to look at, well, what does the 45V clean hydrogen production credit do for the facility definition? It's a single production line, right? It's all the steps necessary to produce the hydrogen. And similarly, the clean fuel production credits, all steps necessary to produce the clean fuel, but you're looking at from the actual begun of processing the feedstocks all the way through the point of producing the fuel, okay? 45V and Z are unique from Q in that they have very specific production equipment definitions. They have some indirect and post-production equipment that's excluded. And so there is a world where both of the V and Z credits analyze whether carbon capture equipment is included as part of your facility. And as Hoo said, you look at all the components that function interdependently, but also to achieve your carbon intensity score, whether it be for V or Z. You can't expect to double dip and say, I'm going to claim a Q if I'm also going to offset my carbon intensity on my fuel production facility with carbon capture equipment and claim a Z, right? You're offsetting your CI with the benefit of sequestering CO2. The government said that that's not what we want to happen here. Statutorily, the 45Z credit has an express prohibition on this type of activity. You know, one thing to think about is what is interdependently functioning. And this really is a facts and circumstances analysis to get into the weeds of it. If you had carbon capture equipment on your electricity production equipment, okay, we feel confident that would fall outside, right? That's not going to be included based on the way the statute and regulations and the proposed regulations are currently drafted. And if you are also maybe, let's say it's an ethanol facility and you're capturing the CO2 off of certain tanks, you know, whether or not you're able to claim both Z and Q is going to be a fact and circumstances analysis. Are you trying to offset your carbon intensity score or not? Do you need the carbon capture equipment to achieve the carbon intensity score that you're aiming for? If not, there's certainly a conversation there on whether or not you can claim both because you still have that interdependent functionality question mark, right? Is there a way that your capturing and processing equipment is so interdependently intertwined with the fuel production equipment that maybe you cannot segregate the facilities? The single process train is somehow incorporated in your fuel production. I'm not saying that has to happen, but I'm wanting you to think about all the facts at play here in terms of analyzing whether or not you can delineate these facilities. I will say we have gotten confident in several scenarios where you're able to segregate. But again, we probably are a little more nerdy than some of your tax lawyers and finance lawyers. We want to see your P&IDs, your system diagrams. We want to get on the phone with the engineer and really get into the weeds of how these credits interplay and make sure you're doing it in a way that will be respected not only by the IRS, but also making sure stakeholders would be comfortable with that too. Now, in terms of stacking, we do want to also kind of quickly hit on, as Hoo said, this is a big math exercise. What makes the most sense? You should keep in mind, as I said, getting other stakeholders comfortable. You should know that the market currently is just kind of assuming that you can't, right? We see a lot of tax credit purchase agreements for 45Z. And honestly, the buyers automatically just assume this won't work. We want you to rep to it that it won't work, right? So just make sure you're thoughtful in that when you start engaging other stakeholders, this is a conversation that needs to start early. There shouldn't be any surprises. You're not doing anything cute per se. It's just a matter of making sure you're following the law and what's allowed.
Yeah, and I think that sort of gets us to a good topic here, which is tax credit monetization. Because at its base, some folks are going to have the tax appetite to use the 45Q credits that they generate, but most folks don't. You know, most folks need somebody else who has tax capacity to help them monetize and get some value out of their credits. So, like we said, you could go ahead and just take the credit yourself. You can use it. You can carry it forward quite a ways. You can carry it back. For 45Q, there are a lot of taxpayers that are able to take direct pay for 5 years. We can pause here for just a second. Direct pay is basically you've turned this credit that's not refundable into a refundable credit. So you would be getting it as a refund on your taxes. That has a clear timing impact, right? So compared to something like taking a transfer of your credits where you sell your credits to another party, which you can do during the taxable year, you're not going to file your taxes until late the following year. And it's probably going to be quite a ways after that that you actually get any of the refunds attributable to this credit from the government. We've heard a lot of rumors, Ginny, I think you can hit on this, that some folks are still waiting for prior tax years direct payments.
That's right. I think while we're talking about direct pay, there were 12 tax credits eligible for direct pay, but really they were eligible for tax exempt entities. Okay. There were 3 tax credits of the 12 that non-tax exempt entities could be eligible for. And two of the three we've talked about today, the 45Q carbon oxide sequestration credit, the clean hydrogen production credit. And there's a third one, an advanced manufacturing production credit under 45X if you're interested in looking at that one too. There's two things I want to cover about direct pay that are problematic. What I'll say is when it was first enacted under the Inflation Reduction Act, the industry was celebrating. This is amazing. This is our chance to completely forego complicated tax equity deals. We are in the clear, everyone. It's going to be bags of money left and right. Well, in reality, the direct pay rules were not written with the most clarity. I'm not sure if when we're comparing reg packages, which ones were, but these were not at the top of the list. Direct pay was only eligible for 5 years beginning on the placed in service date. I don't know about you, but generally when you're trying to encourage someone to place something into service, and that's a tax term again, you usually don't perfectly align it with January 1st of the year. So that means you could have a tail where you'd claim direct pay your first taxable year, that's fine. What happens though is on year 5, right, when you're going to have a partial year that's eligible, you're only allowed to make an election for direct pay or transferability. Once you make that election for direct pay, it is supposed to be irrevocable. They do give you a one chance to revoke it during that 5-year period, and you go to transferability. But the intent was for it to be a 5-year period, and it's not truly 5 years, right? And so you would have a portion of the year 5 kind of in this no man's land. What do I do with it? Your only option would be to claim direct pay on the portion that fell within the 5-year period from start to finish of your placed in service date, and then put the rest on your tax return. And you might not have tax appetite today. You can carry it back 3 years, forward 22 years. That's really the only option you're left with. The other problem with direct pay is it does not fill the OPEX bucket, right? You're incurring all these operational expenses, yet you cannot claim your tax return with the credit on it until the following, usually fall, right? We mostly all file on extension. So you're filling this gap immediately of a year, 9 months or so, 10 months. Then it's waiting on the government to say, yes, we bless your tax return, here's your refund. The rumors out there, it's not just like localized to 45Q. I've heard other direct pay rumors out there. The few that are on 45Q is that from tax returns 23 and 24 are still pending direct pay. I've heard other tax credits from a tax exempt standpoint are still waiting direct pay. I don't say that to scare you. I say that just so that we're all level set on the realities of what we're hearing and how quickly the government is moving on these direct pay elections. Time value of money, transferability is starting to look pretty good, right? Transferability, you're allowed to transact and actually have a cash consideration received as early as January 1st, the year in which you're going to generate the credits. Now, I've not met any buyers as generous to give me money January 1st before I've actually started producing and capturing the CO2, but they could be out there. The rules allow it. So just keep in mind from a transferability standpoint, usually the way we see these production tax credits work is normally on a quarterly tempo, right? You're proving out, hey, I emitted this much CO2, but then captured it, sequestered it. Here's all my production reports of CO2 and the capture reports, and here's the injection reports. So you can kind of show up on a quarterly basis and potentially get money in the door to help with the OPEX. And then the buyer is going to file the tax return. We have obviously your buyer is going to be using those tax credits to reduce their tax liability. And so you don't have the same concern of waiting on a refund necessarily. One thing we want to throw up while we continue to talk about tax credit monetizations is this is generally just how the basic transferability structures work, right? You've got your 45Q project here, your carbon capture equipment, and the project company is going to be, owning, operating, making sure it's eligible, ensuring PWA compliance during the 12-year period, everything that you need to generate those tax credits. And they're going to be eligible for a tax credit. They'll elect on their tax return, whether it's a disregarded entity, maybe it just goes up to sponsor. But generally, you look at this structure and it's either going to be the project company or the sponsor based on whether these entities are regarded. And the sponsor, let's say, would sell to the third-party purchaser. You're going to have a tax credit purchase agreement between these two parties. Maybe you'll have insurance. We have seen 45Q insurance on the market. It is, I'll just be honest with you, more expensive than the other technologies. I think it is a combination of there's still this unknown, uncomfortable with the technology. It is what it is. We're still working on educating others. So underwriters are a little more expensive. They're taking their time, but that doesn't mean it can't be done. We are seeing policies, but just forewarned, they're a little more costly. So the tax credit purchase agreement is going to have traditional reps and warranties that follow the transferability regulations. You're always going to have a backstop. You're going to have an indemnity backstop saying if, hey, seller, you do something that triggers a recapture, or it could be out of your control, but you have a recapture event where the CO2 did come out of the ground. I don't want to be left holding the bag. I want you to indemnify me. That's also where we see the insurance potentially stepping in, parent guarantees stepping in. But really, these tax credit purchase agreements are, I mean, I think we've seen billions and billions of dollars transacted in the transferability market. So we're very comfortable with what standard terms and conditions, and we have seen a couple of 45Q deals, so they're out there. So don't be concerned about looking at the transfer market. It's not scary, and it seems to be a lot quicker than direct pay.
Yeah, and just noting there's an ecosystem that's really developing here.
Mm-hmm.
They're like to talk to us, of course. There are brokers that we work with a lot. You can find some online that have sort of hosting platforms for
Yeah.
these sorts of things. But it is worth noting, like there are a lot of credits on the market right now, and so you are going to be competing with some of these, the solar farm and the hydrogen production facility and your battery manufacturer. We're all looking for folks with tax capacity to take their credits. So we are seeing a little bit of a shift in this market from being a very seller side friendly in a lot of ways in the early days to a more buyer friendly market today. And it's something for you to be aware of as you get into this space. Like we are seeing flat indemnities, flat legal reps in these
Mm-hmm.
sales agreements that sellers generally need to get comfortable standing behind.
That's right. I think we've had several questions filter in throughout the webinar. We'll do our best to answer, but keep them coming into the chat box. I think we've entered the time of the webinar where it's time to do Q&A. So if you have any questions, please feel free to submit them. Let's just start taking through them. I think the first one is beverage manufacturing considered utilization for 45Q? I can say that I previously, as Alan gave my long background, I'd been at Deloitte National Tax for several years and I actually participated in the submission of the very first LCA. We were so excited. And then 9 months later, they finally got comments on it. Just to give context, I just want to say it was not a speedy of a process then. That was many years ago. We have seen the IRS and government just get more efficient here. But what I have heard is I've heard that beverage manufacturing can be a use of CO2. I have heard of LCAs approved for beverage manufacturing use of CO2. So if that is appealing to you, you should get started because remember, you cannot claim the 45Q credit until you have an approved LCA by the IRS. So that is something if you're planning on selling your tax credits and you need utilization, make sure that you get that LCA process started right away. There is a separate safe harbor for 45Q that if you get an approved LCA and as long as it does not materially change, you can rely on that for a couple of years. So food for thought,
Yeah.
pun intended.
Just flagging here. Most of this discussion has been focused on enhanced oil recovery or other forms of geological storage. That question was toward this other prong in 45Q, where if you utilize CO2 for some other commercial purpose, maybe you're using for beverage manufacturing, maybe you're doing ethylene production, something like that. In each of those, the government does a life cycle analysis to substantiate how much CO2 is actually utilized compared to some base case in determining your credit amount. So just on this beverage manufacturing, you likely would not see a full $85 per metric ton. It would be likely to be a lower number based off of how your utilization in its total life cycle analysis actually reduces aggregate CO2 emissions. Also, just so everybody else knows, you don't have to do a life cycle analysis if you're putting stuff down whole. It's
Right.
not something to worry about.
You don't have to do an LCA, but you also don't have recapture if you're using utilization. So
Fair enough.
on the same vein, there's another question. Can commercial utilization of captured CO2 be used for a CI reduction for 45Z, 45V? The answer is one day. right now, our lovely Greek model just does not have the functionality or the ability to recognize utilization. I think it's because, as I mentioned, you need an approved LCA. And so I think the DOE, when they were making the Greek model, probably was like, I don't know how to incorporate that. How do we fact check it? So right now, it is not one of the approved methods. Use or sequestration. So EOR and sequestration are the two methods that you can model today.
Yeah. And the punchline there is it may be possible for you to do 45Q for commercial utilization and take the
Mhm.
45V or Z credit. You just wouldn't get the benefit of those CO2 reductions in calculating those other credits.
That's right. There's a few questions in here on scope and boundaries of PWA. As we mentioned, that's really a facts intensive analysis. We have the benefit of working with an amazing team here who and I are not just in a silo alone. There are a lot of attorneys here that touch various pieces of the carbon capture, storage, transportation, PWA, from environmental, you name it. So we actually have a colleague in our labor employment who is an expert in PWA. He studied the Davis-Bacon Act. He's very, very bright. And so usually we collaborate and just go through the facts and circumstances of what we understand on a facility boundary, making sure he's as well comfortable. But really it does depend on, does it include transportation sequestration? As I mentioned earlier, the general answer is no. There could be anomalies where it does. In terms of 45V, very similar. You'd want to look at your single production line of producing the hydrogen. If it's downstream storage, the terminal, usually those are going to be outside your boundary because that's post-production. But again, that's something that you'll want to talk to your advisors about. Let's see, do you think they'll further define qualified facility? That's a good question. I think the answer is yes. And that's because whenever they changed the capture thresholds under the Inflation Reduction Act, that inherently changed the qualified facility definition. So the regulations will need to be updated there, address the electric generation unit concept. So there are a few impacts under the Inflation Reduction Act that I do think the 45Q regs will need to be updated.
It also matters a lot more now in a PWA world than it did previously. So I think the
Mhm.
IRS could be a little bit more cavalier with their qualified facility definition. But now that
Yep.
we need to know that scope for PWA compliance, it really is a germane topic.
Yeah, and so if you are of the lobbying type, I would recommend, go ahead and start getting questions, comments into the government early saying, hey, we do need the qualified facility definition to be revised and consider it in light of the PWA. Maybe that is the time to try to affect change. I know we have 1 minute left. I just want to personally thank you all for joining us over your lunch break today. Please reach out with any questions. If we missed any of your questions, our team will send them to us and we'll do our best to follow up. But happy to talk to you and have a great day.